That's part of it. That's certainly the argument that Charlie Evans, who Steve knows, who spoke with, has argued, John Williams as well. The economy looks good at the moment, but a lot of the survey data looks a lot softer. We had some information this week from Cass, the freight company, that showed a significant fall off in activity. And with inflation undershooting and the trend, Melissa, probably being lower, the Fed is being prudent, I think, and is trying to be forward-looking. And that's why they'll cut.
We've seen that also in some of the earnings. I mean, whether it be CSX, which is down a lot today. We heard it from Fastenal, which was able to pass through some price increases, but also saw not just the impact of the tariffs, but also cost inflation, and that they are limited in terms of how much more they can pass on. What's your take from this, and how do you translate it into what we're seeing in earnings season so far?
Well, I think it's clear that this report sort of supports what the market's been saying for quite some time now, which is growth is slowing. Inflation is undershooting, persistently undershooting, and the risks are to the downside. We've seen, again, this uncertainty impact capital spending. We've seen a slowdown in trade-related activity. You referenced CSX and some of the other indicators, earnings and macro indicators that we've seen. That's already priced into the market, Melissa, so I think expectations for earnings are already very reasonably low. So as these reports come out, we see some misses and some minor market adjustments as a result, but I don't think anyone's expecting anything heroic from earnings this season.
Steve, you want to jump in here?
Yeah, I just want to point out, if Joe is right, and I'm not saying he's wrong, I will point out Joe is a participant in our CNBC Rapid Update, which is running, the median's running 1.8 for the second quarter, and Joe is down at 1. So he's on the pessimistic side. If Joe is right, though, Joe, it would be the most exquisite bit of timing where the Federal Reserve is cutting interest rates right at the absolute peak of the job market. I've not seen a Beige book go at length about the tightness of the job market, I think, almost ever. If you read each individual entry from each of the districts, which I did, so you don't have to, Joe, even though I know you will, but the things that the employers are doing, training programs, extended parental leave, all over the country here, it seems like you have this worker shortage. And so the Fed would be cutting rates would seem to be at the peak of employment here.
Yeah, I mean, those are fair comments. Janet Yellen, I was like what Janet said when she said that the tight labor market would be the best job training that we could get. And maybe that's what's happening perhaps in the Minneapolis district, as you were reporting. The one thing we're sort of forgetting, again, is the yield curve. And that yield curve is extraordinarily flat. It's inverted in most pockets. And that, to me, is a telltale sign of where the direction of GDP is going. And the fact that the Fed has not been able to generate more cyclicality, and we've got weakness in housing, which people aren't really talking about. It's always about the trade. But the housing numbers today were really soft. That's a function of mortgage rates having risen a lot last year. This economy, I don't think, is as robust as people believe, and therefore needs some help.
So you say cut the rates 50, a half point.
I like them to go 50,
July.
absolutely.